Intercompany transfer of services and non-current assets. We're going to look at a downstream sale of depreciable equipment. We're going to focus on the equity method in this learning objective. As you can notice, you see X7 here. So we're going to start not in the first year of the equipment, but in the first year of the transaction. So X7 will represent the first year, X8 the second, and so forth. Here's the information that relates to the purchase acquisition between the parent and the sub. The item of importance, though, is this information. Parent sells equipment to the sub for $190. The parent originally purchased equipment in X4 a couple of years prior to the sale. And the subsidiary is going to continue to hold the equipment for several years out. And the parent and the subsidiary are going to use straight line depreciation, and the equipment has a 10-year life. There's going to be a gain on the sale, which we'll get into, but here's the information for separate operating income and regular income, etc. Here is the information for the second year, X8. And let's focus on the X7 or year 1 stuff. We'll look at the three things of importance: subs net income, dividends, and then any special allocation items. And you can see here we've got an unrealized gain or loss, and then we're going to add something to this, and that's going to be depreciation. Here's the information again, and here is the subs net income. Here's the information to record that through the equity method. Here are the dividends. And the focus of this learning objective is going to be on the unrealized gain or loss and the depreciation. Let's address the unrealized gain first. Here's the information again. So let's go ahead and back up a little bit to when the parent originally purchased the equipment back in X4. They would have made the following entry: debit equipment, credit cash for $225. The parent is going to depreciate that equipment over a 10-year life, and for this class we'll use the straight line depreciation. And here's the formula in case you've forgotten. It's going to be cost minus salvage value divided by the estimated useful life. If we take that, we get $22,500 a year in depreciation. So on the parent's records for year 4, 5, and 6, they would have made the following entry. And notice that the sale of the equipment took place on January the 1st of the 7th year. So what that means is that the parent will not depreciate that equipment at all for X7. It will be in the subsidiary's possession, so they'll depreciate it for X7. And that's going to affect any gain or loss that we may have. Here's the gain or loss computation that the parent would do. And let's start at the bottom first, and we'll work our way up. You see that we needed to accumulate the depreciation amounts, and we've got that for years 4, 5, and 6. It's $67,500. To compute the gain or loss, we're going to take the sales price minus the net book value. And the net book value can be defined as cost minus accumulated depreciation. So in this example, we have a sales price of $190, a net book value of $157.5, and that leaves us with a gain of $32,500. So the parent would make the following entry: the debit cash, what they received. They would remove the accumulated depreciation that's on their records at this point, which was the $67.5. They would take the equipment off, and then they would record a gain. Now, we kind of have an idea at this point that the gain is there, but is the gain to a third party? And the answer is no. So we have an unrealized or deferred gain here. So we're going to have to pay attention to this as we progress. And again, the gain is overstated. So we've got to do something with this overstated gain. And what we're going to do is very similar to what we did with the land, is that we've got to take the gain out or reduce the income. So we're going to debit income from sub, credit investment subsidiary for $32,500, and we'll do that again. We're in the equity method of accounting. This leads us to the new item in this learning objective, and that is depreciation. And we're going to jump to the subsidiary side of the accounting now, because this is where depreciation will kick in. The sub purchases the equipment for $190. So on the sub side, they would do the following: debit equipment, credit cash for $190. Now you know this already, that if someone buys an asset, they're entitled to depreciate it. And we're going to use straight line depreciation as well, so it'll still be the same formula. So the sub will, during the course of the year, depreciate this asset. And what they're going to do is the following. We're going to take the cost minus the salvage value, but there's going to be a little difference here. Now, the equipment has a 10-year life, and that 10-year life is going to follow that equipment for the entire process, since this is a related party sale. What we're going to do, though, is since the 10 years is following to the sub, we're going to have to subtract off the years that have already been used on the equipment. In this case, year 4, year 5, and year 6. Even though it's on the parent side, we still have to subtract it off. So we're going to take 10 minus 3, or 7, divide that by 190. Divide 197 into that. We get 27,143. Now, what we have to do when we have depreciation, which the sub on their records gets to record that depreciation, no big deal. But with related party transactions, we can be no better or worse off when we consolidate. So we have an issue here, and it comes up with the depreciation. So here's what we have at this point. We've got the sub taking $27,143 in depreciation. The parent was taking $22,500 in depreciation. And we can take this $27,000 and break it down into two components. Of the $190,000 that the sub purchased, it represents $157,000, the book value that the sub had, and the gain that the sub had, which was $32,500. And if we amortize that gain out over the remaining life, the $32,500 divided by 7, we get $46.43. And what we see is this, that the parent was taking $22,500, the sub is taking more than $22,500, and the reason they're taking more than $22,500, it's that gain amount, or the $32,500 that they're taking. That gives us the $27,143. So $22,500 plus $46.43 gives us $27,143. So what happens is the subsidiary is taking more depreciation than would have been taken had the sale not taken place. So they're taking $4,643 more in depreciation than would be allowed had they not purchased it. Okay? So what we refer to this as is we say there is excess depreciation, and that excess depreciation is $46.43. So if we think through this, in the subsidiary's net income that's flowing over to the parent, there's $27,143 in depreciation. Okay? How much depreciation should be taken? $22,500. Okay? So what has happened is the subsidiary's net income that is flowing through is understated by $4,643. So that means we need to increase the income from the subsidiary by this excess amount. And when we do that, if we add $4,643 back to the sub's net income, what that does is, in effect, makes the depreciation $22,500. So what we're going to do is we're going to add back each year that excess depreciation amount. So the way we're going to do that, and again, remember the equity method of accounting, all items relating to the parent and the sub during the equity method run through the income sub account. So what we're going to do is we're going to debit investment subsidiary, credit income from subsidiary. What that's going to do is that is going to increase the net income from sub number, or the income sub number, by $4,643, which in effect brings the depreciation expense to $22,500, which is what it should be. So if we recap the journal entries, we get the following. And let's look at the reconciliation. I think it's going to be a little clearer if we do this. If you see the sub's net income of 70, and we take this 4643, I've listed the depreciation here for you. So if we add that 4643 back, that makes depreciation 22.5, which is what it should be. So we see several things happening here. One is in the $56,000 that's going to the parent, we've got to undo the effects of that deferred or unrealized gain there, and we're going to subtract it out of that income, and then we're going to add back some excess depreciation. From this, we can compute our book value schedule, which you see. We can reconcile our investment sub. And notice, we really don't mention this every time, but all this investment reconciliation here, this is no more than us taking the equity method journal entries that we make during the year and posting these to a T account. It's no more than that. So kind of recapping all the equity method entries into one place here. We can look at the non-controlling interest, the NCI, and we see that since this is a downstream transaction, there's nothing to affect the NCI account.